Good morning, everybody. Hope everybody's doing well. We still have some people entering our virtual meeting room here, so we're going to give it probably 30 more seconds, wait for this number to level off, and then we'll get going. I do appreciate everybody taking the time this morning to join us. So bear with us here just a second, and we'll get on our way. Okay, it looks like that number is starting to level off now. So with that, we'll go ahead and get started. And again, good morning. My name is Clint Long with WealthSouth. And this is the first in what's going to be an ongoing series titled Wealth Watch, where we go through and just speak to the financial news of the day, if you will. Although we're obviously seeing our lives grind to a halt in terms of what we're allowed to go out and do. Obviously, there's quite a bit going on in the world. So what we hope to do over the course of the next 8 to 12 weeks is discuss with you what that impact is, or excuse me, what impact that's having on financial markets, financial instruments, et cetera, and ultimately how that impacts you as our client. Obviously, our day job is financial professionals, so if you tuned in expecting a flawless broadcast, you're going to be sorely disappointed. I definitely wanted to get that out of the way at the outset. With us today is Bud Watson. Bud is here in our WealthSouth office. He works with us as a wealth management advisor and a financial planner. He's also a certified public accountant. He has years of experience and a wealth of expertise, and we're lucky to have him here to discuss our topic today. I also want to point out before we really get going, if you look to the right side of your screen, you'll see a chat function that's been enabled for you. If you will, please, as we're going through, we want this to be as interactive as possible. So plug in your questions. We'll try to get to as many of those as we can during the time we've got here. We're going to try to keep this under 30 minutes so that you can get on with your day, but please feel free to jump in with those as we go through. So Bud, to kick us off here, why don't you explain to everybody, I've used the short form RMD probably twice in the opening. Why don't you explain to everyone what an RMD is and what its purpose is?
Hey, good morning, Clint. Thanks. And I'll echo Clint's thoughts. Thanks to everybody for tuning in. We really hope this is not only this session, but future sessions are of value to you, and we appreciate your time and attention. Yeah, so what's an RMD? We hear that acronym a lot. I imagine a lot of folks are familiar with the concept, but the general idea is because IRAs, 401ks, pension plans, and so forth are tax deferral mechanisms, not exemption mechanisms. Treasury wants their money back at some point. So the TEFRA Act in 1982, which Clint mentioned, I had a lot of experience. I actually was practicing when the TEFRA Act was enacted. The TEFRA Act sort of set out the rules to require distributions in effect over the retirement lifetime of a taxpayer. So there was a determination at that point in time that there would be a point in time when you must start taking distributions, and those would be taken over your lifetime, so that the Treasury would get its money back, and you wouldn't use it as an inheritance tool. So what we're going to talk about today are the changes that the CARES Act has made to the RMD rules.
So Bud, you mentioned those changes that were made by the CARES Act. Weren't there already significant changes made fairly recently?
Yes, it's actually after sitting kind of dormant for a long time, these rules suddenly have become quite popular for change. But there was an act that last year called the Secure Act, which made a pretty significant change to RMDs that actually would be the first change of its kind for basically the 40-year life of this law, where they extended the age where the RMD must begin from 70 and a half to 72. So we've kind of gotten rid of the half, which is helpful. That applies to retirees who turn 70 and a half. The change to 72 if you turn 70 and a half after December 31, 2019. So if you turned 70 and a half last year, your RMDs would not be extended to begin to age 72. So that change is very significant. That remains in place. There is no change to that particular rule.
So Bud, sorry to break in. We've already got
Sure.
Our first question here. What was the justification behind that change, or the reasoning behind that change?
Yeah, I would assume that what was basically presented was that it was because of the fact that folks are living longer and working longer, that age 70 had just become, age 70 and a half, had just become too young to require the beginning of those distributions. And again, that hadn't been changed in 40 years, and certainly there had been a lot of changes to life expectancy and work ages in that time.
Thanks.
So the CARES Act, which is an acronym for coronavirus aid and relief and economic security. Our folks in government really are good with coming up with acronyms, but our CARES Act, this was signed into law just a month ago. March the 27th is when it first came into the law. And it really is simple in the basic change that it makes. The basic change is that the 50% penalty for not taking your RMD is waived for 2020. So that sounds pretty simple, but as with any law change, there's a number of things that people start to think of, a number of nuances that come up. This law, by the way, is quite unique in that it was drafted in a 2 or 3 week period. This type of 900-page legislation would often take months or years to draft, and it would be followed up with regulations and pronouncements and industry experts chiming in. We've kind of had to just sort of dump it out there and all deal with it as best we can. But the basic points that are made on this particular slide that everyone can see is why would they have done this? Well, this initial waiver of the RMD requirement was actually done in 2009 during the last economic downturn, and the concept there is just simply that you don't want to require folks to make a distribution. These RMDs are based on the prior year-end balance. So you would have had the sort of the peak of the market in the end of 2019, would have based your 2020 distribution on that, and now your account balance potentially is much lower. So that was the decision behind that, or that was the reason behind the decision, was to waive that requirement for 2020. And it really applies to all plans. It's not limited to IRAs or 401ks. Every type of retirement plan and IRA that requires an RMD gets this waiver for 2020. And it's not made up, as the slide points out, it's not made up in 2021. So there's not some sort of doubling up next year. It will be, of course, made up throughout the remaining years of your retirement, because if you don't take a distribution this year, your account balance will be higher. And therefore, as we calculate future distributions and future RMDs, those will incrementally be more. Also, IRS is going to change the life expectancy tables and issue new ones in 2021. So there could be some pretty interesting changes to the math starting next year for retirees. The next point on the slide is really important, because most of what we read about from the CARES Act relates to some requirement that you have a COVID-19 diagnosis, or a family member who did, or you're taking care of children, you have a financial impact. None of that is required related to this RMD waiver. You don't have to have any symptoms. It has nothing to do with any kind of diagnosis. It really has nothing to do in any way with COVID-19. So everyone who has an RMD can waive it for 2020. But it's also important to note, as the next bullet point shows, it's not mandatory. It's not automatic. So you can take a distribution it wouldn't be considered an RMD, but it would be a distribution. You're allowed to do that. And also, it's not necessarily automatic. So I think one of the reasons we would like our clients who are interested in not taking their RMD this year, or not taking a distribution, let us know, because there could be an automatic, your custodian could have an automatic distribution set up, whether it be monthly, quarterly, or some date during the year, and we need to make sure that gets turned off.
But just for those
sure.
just for those listening in who might not be attuned to our vernacular, the custodian is just the financial institution that is holding those assets. So just want to set that for everyone.
Right. And of course, if you're not sure in your case, as a client of ours, just give one of us a call and we'll help you think through that. The rule that had been in place about doing qualified charitable distributions from IRAs, that is unchanged. So while that doesn't take care of your RMD this year, it can still be done. So that has not been altered. And just a final point on there, I thought was interesting that most taxpayers, actually about 80%, take more than the RMD. And the reason for that's pretty obvious. They need the cash flow. It's their retirement. So this is affecting a relatively narrow group of taxpayers, but for those who it does affect, it's fairly significant.
So, but probably two takeaways, or one takeaway and one question coming off of that information. One, it sounds like ultimately the action in the CARES Act was geared towards not making those in qualified plans pay an undue penalty of valuations being so high at the end of 2019. That's the right motivator.
That is the primary motivator, and it's been described as helping the same way that our self-isolation is helping health of people. This is an idea to help the health of your retirement. Is one way I've heard it expressed. And
we've got another question coming in. Do you anticipate the new math to be beneficial to retirees? And what's your general recommendation around not taking RMD this year? So I know we're going to get to the answer on the second part of that question, but in terms of the new math, I assume that's the expectancy tables. Do you want to touch on that?
Yeah, sure, Clint. I would think the result of that will be extending life expectancies again, so that we will find that the initial probably all distributions will be slightly lower percentages as our life expectancy increases. I do think there's been some further work done on gender differences as well in those tables. So there'll be more to come. Hopefully, if IRS ever gets done issuing stimulus checks, which I know has overwhelmed their whole system right now, they'll get on to doing that, and we'll find out more about what they're going to present as the new tables.
Very good. It always sounds a little morbid when we talk about life expectancy tables, so I'm glad that's going in the right direction.
At least it's going in the right direction.
Yeah. So we've walked through the federal action, but obviously there are probably some other things that people need to keep in mind when assessing how to proceed with their year 2020 RMD. So what are some things outside of just the CARES Act and the Secure Act to be mindful of?
Yeah, and that's good to talk about. It's also a very developing topic, and one thing I should probably point out before we get into those is just for everyone listening in to be thoughtful that a lot of what you might read, a lot of what you might hear from neighbors, business associates, it may not be totally accurate. The law was quickly written. There was a lot of quick response. You might read something that's 2 or 3 days old, might literally be outdated right now. So these are some developing points that have come up since the law was released, and I suspect there'll be many more as the year goes on. But the first one is something we would always comment on legislation, and this is federal legislation. So we need to be mindful that Kentucky, other states, even other municipalities like Lexington, which do address retirement distributions in their taxing system, may or may not adopt this. So We do need to always be careful that what we're talking about right now are federal rules only, and not to just totally assume everything is exempt for all purposes. Something worth mentioning while we're on the topic of states, Kentucky has an exemption for retirement income, and it's been in the law for a while. They did lower it in 2018. It was 41,110, I believe, and they lowered it 10,000. So now the exemption is 31,110. But that means that Kentucky, at least for now, exempts the first 31,110 of all distributions from IRAs and retirement accounts. That leads sort of to the next bullet point, which I think is the key bullet point of this presentation, and also addresses the question that came in. We really, I think, as a tax advisor, anytime you give carte blanche advice, that's a little dangerous. And this would fall into that category. I think it'd be fair to say that most people, maybe a vast majority, would choose to defer, because that's kind of rule one with tax planning, is to defer taxes if you can. But that said, retirement distribution planning has always involved looking at your financial plan for cash flow, your tax planning, what bracket you're in today relative to what bracket you might be in future years, really dictates not only if you should take a distribution, but even if you should take more than the RMD. You really need to look into your tax and financial situation, and a little bit of crystal ball planning, which is difficult for tax rates. But one would be, if we have all of this stimulus right now, I know some would argue that tax rates are going to have to go up in the future. So then, is it wise to defer from this year into a future year that may be at a higher tax rate? So one of the things that I think is the strength of what we do for clients is financial planning, and really keeping that current. And we can run a variety of scenarios for clients so that we can all sit down and make an educated decision on that. A couple of more detailed points. I mentioned that if you turned 70 and a half in 2019, you would have to start RMDs this year. That actually would have been waived, or could have been waived, under this CARES Act provision. So that raises the question of the last point is, well, so what happens if I already took my 2020 RMD?
But if I can
Clint.
stop you for just a second, we did get a question. So as you're covering this last point, there's a question specific to, if I took an RMD in January, can I put it back? So as you're going through these last points, if you don't mind, address that January distribution specifically as maybe an anecdotal example.
Of course, yeah, and that's a very common and frequent question right now, and it goes back to the comments I made at the beginning of this slide, that you can't always rely on what you might read if you Google this, for example, because initially the reactions were, you can't put it back, which is technically correct. So you can't just return it as an RMD. However, as folks have thought about these rules, well, there's a couple of ideas that have come up. One would be, if you took it before now, this waiver of the RMD is retroactive to January 1. So that means it wasn't an RMD, which now means it's eligible for rollover. RMDs can't be rolled over, but if you took it in 2020, it therefore wasn't an RMD, because they're not required this year. So it's eligible for a rollover, which is called an indirect rollover, meaning within 60 days of taking it out, you can roll it back. So you're in a sense putting it back. That in some cases, in many cases, maybe the 60 days has already passed, but IRS released a notice last week that extended any rollover that would have been due after April 1, where the 60 days would have expired after April 1, is extended to that magic date of July 15th, which we're using for a lot of tax law. So that gives you a rollover option. And remember that for IRAs, you can only do one per year, but there is a rollover opportunity then. And if that's not available, there's also, and this might be a topic of another session, but there's also the availability of the COVID-19, if you have a COVID-19 impact, and this gets a little bit different from what we've just talked about, then there's a different provision in the law that allows you to take 100,000 out and potentially either pay the tax over 3 years or repay it to the plan or IRA within 3 years. And so if you've already taken it and you could sustain the argument that you've had a financial or health impact or family impact from COVID-19, you then could take advantage of that rule. So there's a couple of really accessible options for putting distributions back if they've already been taken for this year. Again, I wouldn't just do that as a knee jerk, though. I think we go back to is it wise to defer this year and not just automatically defer without doing a little bit of analysis. So I think that covers the thoughts we have for now. Again, I think there'll be more as we go along, as we all think this through further this year.
But ultimately, the takeaway from I think you called it carte blanche, or from a blanket answer in terms of what do I do with regard to my RMD, the answer is every situation is the individual situation, and every answer is going to be different, it sounds like.
Yeah, certainly many answers may be to defer it, but I think it gives us an opportunity, I believe, to rethink how we are setting up our RMDs. I know that in a lot of cases we just default to deferring, not only this, but just even in general. And I don't think that's always the right answer, because you do have to think about tax brackets, and particularly suppose someone has reduced income this year because of the economic downturn. Would this not make a good sense to go ahead and take a distribution this year because your bracket's going to be much lower? So you're right, Clint. I don't think it's right to just assume defer. Great.
Well, as we come to the end of our time here today and covering this specific topic, we certainly want to open it up one more time. If you have attended today and you do have any final questions, please, over the next minute or so, if you could submit those. But if you're just looking for what do I take away from this, what do I do with this information, we've provided a summary here. Obviously, first and foremost, there's been significant federal action. So make sure you've got a good idea of what that is and how that impacts you. Secondly, outside of that, specific to the year 2020, there are other considerations that you need to take into account, in which both of those bullets lead into 3, which Bud just hit on, and which we think is the most important aspect of this, which is have the discussion with your financial advisor, have the discussion with your tax advisor, make the best determination for your situation. Don't defer just because you heard somebody on TV said you can defer it, but analyze your cash flow, your tax situation, and which one of these avenues is going to work best for you as an individual. Looks like we are not getting any more questions here. So with that in mind, Bud, thanks very much. I think it's been very informative and useful to those in attendance today, so we appreciate you taking the time. I do want to put an ask out to those who are attending. As we said at the outset, we're going to be conducting these conversations weekly. So we'll be back here next Wednesday. We're going to be covering financial planning with Tim Yessen from our office. We'll talk about what has changed based on some of the recent happenings in the market, what's likely changed with your financial plan that you need to analyze, and then what stays static in financial plans. So Tim will come on and be a resource to us on that topic. But if you would, reach out to whoever your contact person is here at WealthSouth. If you've got topics that you'd like us to cover, please feel free to shoot those over to us via email or telephone. We'd be very interested to hear what those of you out there would like to be talking about. So with that, thanks very much for joining us today. We look forward to seeing you next week. Stay safe and take care.